All right. Welcome back, everybody, to Facebook Live with Nomad Financial. I'm John Nagast, the founder and CEO of Nomad, and I'm really excited to have Mike Rogers from Interplay Ventures with us this week. I know last week we had a different kind of venture capital approach in which I think most of that was around giving people advice on pitch decks and materials and a structure of how to go into it. Whereas ideally, our goal is to have just a frank conversation about VC in general, what it's like to be a VC, your investment theses that you work off of, what interests you, your story.
Yeah. Well, I'll say I caught last week's show and I saw Mark on there, and I mean, there's few people who are as good at that as he is. So it's tough to follow up and act like that, but I'm excited to be.
We're glad to have you, Mike. We know that you've been all over the New York tech scene, looking at a number of different interesting investments, but maybe start taking a step back and talking your background. How did you end up in this role as a VC? Was it something you knew you wanted to do also, or is this did you find yourself going through a process and end up here?
Yeah, I mean, I think I probably have a little bit of an atypical venture background in that I went to the University of Wisconsin, so shout out to any Badgers out there. Came back to Big Ten. Came back to New York and actually wound up in a trading role at JP Morgan. Spent a few years doing that, learning how to look at companies and really understand balance sheets and financials. So have a bit of a background there, but that's more public market side, which is a very different world than we look at here at Interplay on the kind of earlier stage investing. Left there, spent some time at Barclays. Wasn't the place for me. Kind of a similar vein, ethos, culture, and just overall, I thought looking at kind of the later stage companies in public markets was a lot less interesting to me. There's less innovation there. Growth is more stagnant. It's not as fun and lively, I think is the right way to think about it. Left that, spent a couple months on the road exploring, came back and met Mark and kind of fell in love with the Interplay ethos and what he was building here, the culture and the ideology behind all of it. Came in and worked on a bunch of special projects with him. Some of them kind of in founder seats, working with different the portfolio companies. And in that time, was meeting with a big portion of the New York venture community and built that network. Was starting to see a lot of deal flow naturally and fell into the role a bit. So I think it's a mixture of background that caters to it, a lot of hustle, and just naturally being around the rim and being able to fall into a seat where one opened up, which the more VCs I meet and the more people in the industry, it's a lot of it is just determination and making sure you're in the right place at the right time.
And that's a really great point, right? That you'll meet a lot of VCs who will figure any way possible into this world, right? That they will look for any way to support a current venture capital firm or VC directly, that they will help them make connections, that they will be part of this world, whether or not they have a full-time role doing it, so that when opportunities do pop up, they've proven themselves, they've shown that they're capable, and it's a natural evolution.
Totally. And I think one of the big differentiators between getting a role in the VC and getting a role in a hedge fund per se is in the VC world, deal flow is so key to a firm's reputation and just the firm's ability to deliver ROI. And deal flow is truly obtainable by someone who wants to hustle hard and get out there and meet founders and build a network for themselves. Versus getting a seat at a hedge fund or private equity fund, you have to either have the seat or you have to be at the firm. So it's a very different world in terms of how deals come in the door. And hedge fund being, you just look at public markets and anyone can invest in anything. And private equity, similar but different. And the VC world is really, I think it's a lot more hustle and a lot more driven by your own ambition.
So a couple things that Mike went over really quickly. One being is he understated his epic travels after leaving trading.
Yeah.
And the second thing was when Mike interviewed with Interplay, I had a chance to interview him. And he was sitting down on this really low couch. And I'm on this high chair. And so, that was the only frame of reference I had to him after interviewing. And of course, him hustling that night, and then I ran into him at a VC event. And he's suddenly, this guy come up to me 3 inches taller, and it was hard to place him out of context. And I realized, I was like, man, maybe he's too tall to have around the office. I don't want to be the short guy.
That's the last time you were taller than me.
So, Mike, so So we're going to transition that. You're now a VC, right? What are some recent investments you made? What are the kind of the amazing companies you had the chance to be part of?
It's good timing, so I'm very excited to announce. Mark announced on his blog last week, but we've recently closed an investment in TemperPak. TemperPak is a Richmond, Virginia-based company, which is totally changing the way cold shipments and cold chain packaging is in the market. And it's a very interesting time for that with the rise of the blue aprons, and now Amazon's going to have a similar competitor, as well as the general e-grocery market growth. People have been looking at how do we ship these packages, keep them cold, and do it in a sustainable way. I mean, we all know what styrofoam is. No one likes getting a box full of styrofoam. We all know that styrofoam is one of the worst things for the environment. It never goes away. So how do we have a similar price point that is sustainable and recyclable? And TemperPak's built that, and it's amazing to see the double bottom line with an investment like this, where it's a great business, it's great for the environment, and it's what the consumers want. I think a major pain point for a lot of these e-grocery businesses was customers not knowing what to do with the packages. So you can recycle the box, but you can't recycle the insulation. What do you do with the cold pack in there? And you saw a lot of people leaving the industry because they just thought it was wasteful. And TemperPak came with a great solution, allowing companies to have the best of both worlds.
And as a sector, right, that is irrelevant to you guys, right? This is a company in packaging.
Yep.
Right. As from a stage perspective, where did they fall?
Yeah. So we did their Series A. They raised $10 million, which was a great round for these guys. Big congratulations to Brian and the team.
Yeah, congrats, guys. That's awesome.
And for us, we really like to look for companies with product market fit and traction. When they came in, they had several large customers that are well-known names to most people watching this right now. They had proven that their product worked and that people liked it, and they were scaling rapidly. And what they needed was capital to help build another factory, ramp up production, hire more people, and really scale the enterprise forward, which is kind of where we like to get involved.
Yeah, and there's a typical point for a Series A play, right? That the concept's proven out, that you have data around LTV, around CPAs, around the mechanics of how this is going to work, and it's about putting gas on the fire.
Right, and that's exactly where we like to get involved. You nailed it with the gas on the fire thing. So they've got it, things are burning, the company's chugging along. How do we pour more on this and get this thing really ramped up and further build our defensibility? So a lot of players in this space, if they don't raise adequate capital, other people can come in and take market share from them. But with a little bit more money, with a little bit more experience behind them, this is where a lot of companies at the Series A can really take themselves from being a newcomer in the space to a market leader or someone who's proving themselves.
So there's also push forward some more product innovation, right?
Totally. So that was a big thing for TemperPak as well. They had other products down the line that they really wanted to innovate on, but didn't have the capital to get there. And the great part about the venture markets is we can help enable that and further the sustainable practices they're building, as well as helping them build a great business.
And another example of how varied you guys are in terms of the range of businesses, the investment you made before that.
Right. So at Interplay, we like to think of ourselves as generalists. And the beautiful part of being a generalist is you get to see a wide variety of companies and really invest across the spectrum. Another investment we closed a few months back now was in a company called Mohawk. Mohawk uses artificial intelligence to build consumer product brands and sell them on marketplaces like Amazon and Jet.com. I won't dive too much into their technology, but it's a very interesting way to look at it and vertically integrate their supply chain to compete against companies like Procter & Gamble, who are generally very slow to move, very slow to innovate. They're very fixed pricing spectrums because they sell through a lot of different wholesalers. And Mohawk can come in and do this a lot faster, a lot quicker. Not so dissimilar to a lot of the ways direct-to-consumer companies have been disrupting the space for years through outlets like Amazon. But they do it in a little bit more of a niche way, powered by more big data, machine learning, and artificial intelligence.
And they were in an interesting place because they hadn't done a VC round before, but it almost felt like a later stage investment.
Yeah, they had the benefit of having some early capital from some of the founders. So they were a bit further along raising their round, and you pay up in valuation for that too. So you see both sides of the table.
Yeah, awesome. So those are two really cool investments that Interplay's made recently. How do you screen? Like, so we talked about a few of the mechanisms, like stage and some of the evidence you're looking for. What are some of the other elements that you screen for? And you're shaking here. That is Roosevelt. For the Facebook Live folks out there, I'm going to take his collar off of them so we don't make any more noise. He's an attention grabber, as they say.
So sorry, what were you asking as
keep that a bit. Say bye, buds. So what are the screening mechanisms you guys are using for the companies investing?
So I think we nailed a few of them talking before, but we really like to look for product market fit and traction. So for us, as you said, is the company going well? How are things scaling? Where do they sit in their product development cycle? Do they know what they need to do to get to the next level? So a term you dropped before was customer acquisition cost. Do they know what it costs them to acquire a customer, and then what is the lifetime value of the customer? So CAC to LTV ratio, and that's something that we really like to see, especially with companies that your screen drops off, especially with companies that have a product that they're selling direct to consumer. And in the B2B world, it can vary with different metrics there as well.
Got it. Very cool. So that's from the VC perspective.
Yeah.
Now we look at the founder perspective, and they're coming to you, and yes, there's the capital need, but they're going to come to you to solve. What are the other things that you provide as a venture capitalist that makes a company or founder make it would say, definitely yes, I want to work with you, kind of separating the value of you as a VC outside of the company?
Yeah, and this is key, especially in what is becoming a more and more competitive venture landscape, which is, I think, founder friendly. And the fact that there's more available capital for them to raise, and there's more VCs for them to build a partner with. And on the VC side, it's good too, because we have to show why we're differentiated more and more. At Interplay, because that's the one I can speak to, we have a couple big value adds. And one of them is going to be the platform of service businesses that Interplay has co-founded, Nomad Financial being one of them. And
we did not ask Mike for this call. We will definitely take it.
No, but to be honest, I think one of the things that we like to show and help provide for our companies is the fact that we have a lot of resources in terms of knowledge, and the knowledge share, the brain share is huge. And you bring guys like Jonathan in who are experts in his field. You bring guys like Benji Markov in who are experts in his field at Founders Shield. You bring guys like Greg Cashel, Eric North, who are experts in their fields. I mean, that network of informal advisors is huge. And these are all weird things that founders should never need to know about, and they shouldn't waste their time knowing about, but they're very important. And they come to guys like you, like Benji, in order to scale and help build a company. And we like to think if we can reduce that founder waste of time by 5%, what's the downstream impact? How many more jobs can they create? How much more money can they make? How much bigger can the company be? And what's our impact on that? So we like that we think that's a big value add. And Interplay and the network of companies we built obviously have a lot of job applicants. People come in because I think Mark and the Interplay team built a great culture. You built a great culture, and people want to be part of that. And unfortunately, we can't hire everyone. Yeah. So we share our talent pipeline with companies that we invest in.
Yeah, which is not insignificant.
No, it's
or I guess in normal English, it's significant.
It's substantial at this point, and there are a lot of really qualified people that we would love to join the teams here, but unfortunately, it just doesn't always work that way.
No, but sometimes it looks more beautiful, right? That ends up in a business with a better fit, with a better alignment of values and goals and dreams for the individual and the business, right?
So we love being a pipeline of helping people find and realize that their goals with the companies.
So if you're working with companies or you're screening companies, what are some of the kind of core metrics that people should keep an eye on that matter most? And I know there's sectors around that, so feel free to either dive into specific sectors or keep it general.
Yeah, I mean, I think it is a tough question because it really is very industry dependent. But as I said before, really understanding what it costs for you to acquire a customer, because especially in today's day and age where there's a lot of the marketing world is very heavily focused on Facebook and Google. And they own a huge, huge percentage of all ad spend. And to be honest, it's probably still the best way to acquire customers. But what a lot of people don't realize is in highly competitive industries, whether or not your idea is totally new, doesn't mean that there aren't people who are paying for the same keywords. And what you find is people who think they have these great ideas and they're realizing, wow, because I'm in fashion and I'm trying to acquire the mind share of the 18 to 24-year-old woman, it can be very expensive to market to those women. It doesn't matter how great your idea is, you're never going to get anyone to know about it because you're competing with the ad budgets of Chanel or XYZ big fashion brand, and they can spend a lot more money than you can. So it doesn't matter how much you can raise or how great your idea is. If you can't gather mind share, then you're in a really tough spot. So really showing that you can acquire customers for a price that makes it worth it to you, I think in today's extremely siloed media world, it is really important to us. And the other thing is, just general market size. I think people underestimate how big a market has to be in order for it to be a good venture investment.
Yes. Yeah.
Which can take us back a step and talk about the over-venturism of today's company building world, which I think with Shark Tank and the rest of this kind of Hollywoodization of venture and startup and Silicon Valley, etc., everyone wants to raise venture money. And if you talk to Mark or other people who've been in the game a little bit longer, you'll see that most of these businesses don't actually need to raise venture money, and they're in fact not. Raising money doesn't help them. There are some that do, and that traditional world is flourishing as well. But I think one of the things I've seen is a lot of companies coming in for venture money because it's the cool thing to do, and not because it's the right thing to do for those founders. So for us and for these, I like to make sure it's a business that we think can be big enough to warrant a multiple that is worthy of investing money, and not just taking equity from some founder because it's the thing to do.
It's funny, that viewpoint about what can you do without having to take external money. I remember I was judging a pitch competition recently, and one of the pitches, the amount of money somebody wanted to raise wasn't that much. I want to say $15,000 or $20,000. It was just a lot of small emerging businesses. And what I found out when the founder was going through his metrics was that he had achieved a certain level of profitability above where he needed to live off of, right? And it was just taking that additional income, his profit, and his dividend into his pocket. And so I asked him, I was like, well, what if you just took that margin, the difference, reinvest in your business? One, it's a tax benefit, but two, then you don't have to go bring on an additional party. You have to invest energy in raising that money. You don't have to worry about their expectations. Instead, you're going to just go out and perform. And I hope that piece of advice really made his entire day worth it.
No, because in a lot of situations too, I mean, that people have to realize venture investors are beholden to LPs, and LPs have to get their money back at some time. So a lot of these businesses that are to your point, that are lifestyle or cash flow businesses or will grow naturally fine with reinvesting capital, aren't good venture businesses because venture investors need to get their money out at some point. So a company that someone might not want to sell a few years down the line, they might not have a choice.
That's a great point. Some seed investors can be family offices, it can be personal money.
Right.
They might have a very specific time horizon. Founders should ask and find out about that. But definitely with VCs, they're going to they announce these large funds on every 2 or 3 year cycle.
Yep.
They're not the top, they're not the kings of the hill, right?
No. And I think people should be one of the pieces of advice I give people, like that's not a good fit for us, is just to be very careful who they pick their partners with. Make sure their time horizon is the same. Make sure their goals are the same. Does everyone want to sell the business somewhere? Are people okay taking dividends? It really depends on where you sit in the spectrum, but I think it's very important. A lot of people end up getting in trouble because they get into that with the wrong partner.
And then that's a really interesting point around time horizons. I think a lot of people have these expectations of the fast exit, right? Or they think about Uber now and the liftoff it had over the last 3 or 4 years, ignoring the fact that this has been around for years before that, struggling, right? Travis, for all the negative press they have had recently, and him stepping out, if you go back to early stages, he's really doing the typical like sleeping on couches, I think, and counting every dollar to build this business, right? The glorious stage that comes later, everybody ignores all the trench digging before,
right? And that's pretty classic. I think you see a lot of people come into startup founders' offices and now they have a beautiful big office, they've raised a big round, they finally have some food in there, there's something to drink, And when you get the whole story, you get the days on the couch or in the friend's apartment. And honestly, for me as an investor, yeah, I love hearing that because I think they know how to stay scrappy and they know how to run a lean startup.
Which is much more important than the shiny metrics, the new office, all these things that are arguably temporary, not a reflection of the core value of the business.
Totally. I mean, we've all heard the stories and seen them or lived them about the big startups shutting down.
Yeah.
And it happens, I don't want to say too often, but it happens enough that we have to make sure that you keep things in check.
Yeah, employees aren't going to quit a company because someone else is providing like a little bit nicer snacks or a slightly nicer office. The job to them is about having an impact and what can they do and where is that going to take them? What's their personal growth story? Right. That's a ton more important than the vanity pieces that people get caught up on.
Yeah, I think that stuff got a little overhyped. I think millennials want an impact, to your point, and I think they're much more interested in feeling like they're part of something than they actually care about the amenities of the job.
So, when people think about how long that company takes to grow and eventually exit, what do you guys think about what that horizon should be with a lot of investments? Do you guys have a typical range you're looking at?
Yeah, so I think we generally get involved around the Series A, which to me means the company's probably been in business for 3 years on average before we get involved. And then I think if you look at the statistics right now, it's about 8 years for most venture-backed companies, and that number is just getting longer.
Is that 8 years including the first three?
That includes the first three. First three. So we're looking at about a 5-year time horizon from the time we get invested. But I would warn anyone who thinks it's going to be 5 years to be ready for another 7.
Yeah,
at least. Because and part of that has been the growth of growth stage capital, and the capital markets becoming more accustomed to funding startups at later stages. And I don't think that's a cyclical thing. I think that's here to stay. As the venture markets have matured, you will see more people investing at different areas of the capital stack.
Yeah.
And I think the need, like regulatory-wise, the need to go public is being pushed later, and there's more capital available to help you scale. And being public, unless the requirements of being a public company change sometime soon, they're a massive burden. And it's I don't see the startups of today and the founders of today wanting to go public until they absolutely need to. And maybe Uber's pushed it too long, or maybe some companies have tried to push it too long, but I think generally speaking, the trend will be for longer times.
It doesn't help when the most popular, well-known consumer brands that do go public struggle out of the gate.
Yeah,
like Blue Apron is right now. Yeah. And whether or not it's a true reflection of where that business is end up. There are a lot of well-known businesses public now, gigantic ones like Amazon, that were doubted and struggled on the public markets initially.
Totally, and it's so some might say that it's good thing Amazon went public, and some say they should have gone out a little bit longer, but go either way.
So last thing I want to ask you, a little more personal, what gets you up every day? What excites you? What is the piece that makes you show up to work and get cranky?
I mean, aside from my colleagues, you yourself included, it's it's meeting great founders. And I know that sounds so cliche, but I think the thing that surprised me the most about being in the venture seat is that gut feeling you get when you sit down with someone who has a vision and is really passionate and is showing you what's going to be the next big thing. And I think I get the question a lot, like, so what are you looking at these days? And the beauty of being a generalist is I don't think I need to answer that, because for us, and for me specifically, I know that I'm not the creative who's going to come up with the next big idea. I entrust the entrepreneurs that are out there to be those people. And when you meet them, and they have the passion and they have the drive and they're laser focused, and so they talk about what gets them up, that's what gets them up every day. And for me, it's meeting with those people and helping them curate their ideas and bouncing ideas off of them and questioning their thesis and having them put me down in my place because they know way more than I do. And I love that. And I think that it's fun for me to constantly be building my network and connecting with more and more people that are changing the way we will all live and the way our children will live down the line.
Awesome.
So
well, thanks, Mike. Thanks everyone for joining, and we'll see you next week.